Hello everyone and welcome. Today we're making options simple. An option is a contract that gives you a choice, not an obligation, to buy or sell a stock at a set price by a certain date. The price you agree on is called the strike price. The contract expires after a set date, just like a coupon. To get this right, you pay a fee upfront called the premium. This is the cost of your choice and you don't get it back. So you pay a premium for the right, but not the obligation, to buy or sell a stock at a strike price before expiration. Why use options? Some people speculate hoping to profit from price swings. Others use them to protect investments like insurance for your stocks. Options let you control more stock with less money, but they come with risks. If you own a stock and worry it might drop, you can use an option to limit your losses. Remember, the basics are the right, the strike price, the expiration date, and the premium. Master these and you're on your way to understanding options. Options are about flexibility and strategy, not just guessing. They're powerful but not without risk. Always be honest about the risks involved. Let's move on to the two main types of options. There are two main types of options, calls and puts. A call option gives you the right to buy a stock at the strike price, useful if you think the price will rise. A put option gives you the right to sell a stock at the strike price, useful if you think the price will fall. Calls are for climbing, puts are for plummeting. Your market outlook should guide your choice. Bullish, buy calls; bearish, buy puts. For every option buyer, there's a seller. The buyer pays the premium for the right. The seller collects the premium but takes on an obligation. If the buyer exercises their right, the seller must fulfill the deal. Sellers hope the option expires worthless, so they keep the premium. Next, let's see how these play out in real trades. Let's look at call options in action. If you buy a call, you're bullish. You think the stock will rise above the strike price before expiration. Example: stock ABC trades at $50. You buy a call with a $55 strike, paying a $2 premium per share. If ABC jumps to $65, you can buy at $55 and sell at $65, making a profit after subtracting your premium. Your risk is limited to the premium paid, but your profit potential is unlimited. The seller of the call, on the other hand, is betting the stock won't rise above $55. If the stock stays below $55, the seller keeps your premium. But if the stock soars, the seller faces potentially unlimited losses. Selling calls without owning the stock, naked calls, is extremely risky. This is not a beginner's strategy. Buying calls offers leverage with limited risk. Selling calls can be dangerous if you're not prepared. Know your risk before you trade. Now let's talk about put options. Buying a put means you're bearish. You expect the stock to fall below the strike price. Example: stock XYZ trades at $100. You buy a put with a $95 strike, paying a $3 premium. If XYZ drops to $80, you can buy at $80 and sell at $95, profiting after the premium. Your maximum loss is the premium paid. Your profit is capped since a stock can't go below zero. The put seller is betting the stock stays above $95. If it does, the seller keeps your premium. If the stock crashes, the seller must buy at $95, risking significant loss. Selling puts can generate income, but you must be ready to buy the stock if things go wrong. The risk is real. Never sell puts unless you're prepared for the outcome. Puts are protection and profit tools for falling markets. Use them wisely. Options aren't new. They date back to ancient Greece. Thales of Miletus used an options-like contract to profit from olive presses, paying a small fee for the right to use them later. Over centuries, options evolved, from tulip mania in Holland to the modern Chicago Board Options Exchange in 1973. Today, options are standardized, regulated, and accessible to everyone. The basics remain. Calls let you profit from rising prices, puts from falling prices. Buyers risk only the premium. Sellers take on greater risk for the premium. Options are powerful tools for speculation and protection, but require knowledge and respect for risk. Learn, plan, and trade smart. You're ready to take the next step.